What if the car you just bought, or are thinking of getting, loses half of its value overnight? This could soon become the harsh reality in the 2025 car market. The American car market is in a steep decline. Prices are falling, dealerships are stuck with too many unsold vehicles, and investors are starting to worry. In this video, we'll explain why this is happening, who's being hit the hardest, and what it means for you. Stay tuned until the end for all the details, and don't forget to subscribe for more updates. In 2024 and 2025, rising interest rates significantly impacted the car market, driving up car loan costs and pricing many buyers out of the market. As interest rates for new car loans reached 6.61% and for used car loans surged to 11.74%, monthly payments became unaffordable for a large segment of consumers. This primarily affected first-time buyers and individuals with lower credit scores who were already in a more financially vulnerable position. The combination of higher financing costs and elevated vehicle prices led to a sharp decline in demand. As car loans became more expensive, potential buyers found themselves unable to secure the financing needed to make a purchase. This decreased demand has significantly reshaped the automotive landscape, as fewer consumers can afford to buy new or used cars. Additionally, this trend has forced car manufacturers to rethink production strategies as they face an oversupply of vehicles in a market where demand has dropped considerably. The financial pressure in the car market has been growing as more people fall behind on their car loans and cars are being repossessed. In 2024, car repossessions went up by 23%, showing that more consumers are struggling to keep up with their payments. At the same time, many borrowers are behind on their loans, with delinquency rates reaching record highs. With interest rates for new cars at 7.3% and used cars at 11.5%, monthly payments have become harder to manage. On average, new car payments are $739 a month, and used car payments are $549. This rise in missed payments and repossessions is adding more pressure on the already struggling car market. Many people now owe more on their cars than they're worth, and the flood of repossessed cars is filling up dealerships and auction sites, leading to an oversupply. Manufacturers ramped up production in anticipation of post-pandemic demand that never fully materialized, leading to an oversupply of cars on dealership lots. With consumer demand for new vehicles declining, dealerships are left with large inventories that they struggle to sell. As a result, many dealerships have been forced to slash prices to move stock, further contributing to the downward price pressure in the market. This oversupply is particularly problematic for both dealers and manufacturers, as the excess vehicles take up valuable space and cost money to maintain. Furthermore, it has led to a situation where trade-ins are becoming less favorable, leaving dealerships with fewer options for replenishing their inventory with high-quality vehicles. For manufacturers, the unsold cars lead to increased costs associated with unsold stock and the necessity to reduce production, which may lead to layoffs in the industry. In 2024, used car prices began to plummet sharply, with some models losing as much as 30 to 50% of their value. The average listing price for a used car has dropped to around $25,251, marking a 7% decrease year over year from the peak prices seen in 2022. This significant drop in used car prices is largely driven by the oversupply in the market and declining demand due to rising interest rates. While these lower prices might seem like a good deal for buyers, it's important to recognize that many of these vehicles are experiencing rapid depreciation. This means that buyers who are purchasing used cars now may face significant losses in vehicle value shortly after the purchase. For consumers looking to invest in a vehicle, this situation creates an additional layer of uncertainty, especially when factoring in high financing costs. As banks respond to growing economic uncertainty, they've made it harder for people to get auto loans by tightening their lending standards. In 2024, nearly 10% of banks made it more difficult to borrow money for car purchases, creating a bigger gap between supply and demand in the market. Fewer people can now afford to buy cars, which means car manufacturers are producing fewer vehicles. Some manufacturers have even had to lay off workers because of lower sales. This problem isn't just affecting the car industry, it's also impacting other businesses like insurance companies and repair shops, which are seeing less demand as fewer cars are sold and financed. In 2024, about 39% of drivers were in a situation where their car was worth less than what they still owed on it, known as negative equity. This means many borrowers owe more on their car loans than their vehicles are worth. This makes it hard for people to trade in or sell their cars without losing money. The problem is made worse by high interest rates and increasing loan defaults. People stuck in negative equity may find it tough to get a new loan or even sell their car to pay off what they owe. This puts a lot of pressure on personal finances and could lead to more loan defaults and car repossessions shortly. Despite the challenges facing the automotive market, some groups are emerging as winners during this tumultuous period. Savvy buyers who are capitalizing on the significant drop in used car prices are making informed decisions to secure high-quality vehicles at bargain prices. With some models losing up to 50% of their value, these buyers are benefiting from favorable market conditions. Repossession companies are also seeing increased demand, as rising delinquency rates lead to more vehicles being repossessed and auctioned off. These companies are profiting from the influx of vehicles, which they can resell or auction for a profit. Additionally, individuals and investors who have avoided over-leveraging themselves in the market are finding themselves in a stronger financial position. With manageable debt levels, these individuals can navigate the market without the burden of underwater loans, putting them in a prime position to make strategic investments or purchases without the same risks faced by others. In response to the challenges facing the automotive market, potential government interventions could provide much-needed relief. Financial incentives such as tax rebates for buyers and interest-free loans for first-time purchasers could stimulate demand for vehicles, particularly in the electric vehicle sector. Supporting auto manufacturers with subsidies and easing import restrictions on essential components could help bolster production capabilities. Moreover, investing in EV infrastructure could create jobs and promote sustainability, contributing to a more resilient automotive sector in the long run. These interventions could help stabilize the market and provide the necessary support for buyers, dealers, and manufacturers to navigate the ongoing crisis. The shift toward electric vehicles is one of the most significant developments in the automotive industry. In 2024, 28% of prospective buyers are considering an electric vehicle, driven by environmental concerns and lower running costs. This growing interest in EVs is expected to lead to a 20% increase in EV sales in the US in 2024. As the EV market continues to expand, manufacturers will need to adjust their production strategies to meet growing demand. This includes investing in charging infrastructure and innovative battery technology, which are key to ensuring the long-term success of electric vehicles. The rapid rise of EVs is fundamentally reshaping the automotive industry, and companies that can embrace this shift will be well positioned for future growth. The automotive market is going through big changes as it adjusts to new economic challenges and changing consumer preferences. The 2025 car market crash caused by rising interest rates, unpaid loans, and too many cars is making things tough for buyers, dealerships, manufacturers, and investors. But there are also opportunities for those who navigate the market wisely. The rise of electric vehicles and potential government support could help the industry move forward. As the market evolves, the automotive sector is heading toward a more sustainable and tech-driven future. To stay informed and make smart choices in this shifting market, don't forget to subscribe to our updates. That's a wrap for today's video. What do you think? Will the market bounce back, or is it heading for a crash? Let us know in the comments below. Don't forget to subscribe and hit the bell for more updates. Thanks for watching.